Hello, I'm Brian Rezny, president of Rezny Wealth Management. We have a great show for you today. We're going to talk not only about the investment markets, but we're also going to talk about the economy a little bit. We're going to take your questions and we're going to answer those today. If you have a question about your portfolio, your retirement, the advice you're receiving, send that to Brian Rezny at ReznyWealth.com. We want to make sure you get the right answers to all of your investment questions so you can make better decisions. I'll also ask you to visit ReznyWealth.com, my website. If you go there for free, you can put your email address in and sign up for free instant email alerts in your email box about important market conditions, important investment advice that we're sending out to not only our TV but our radio listeners. Again, it's free, and you can also go to my website and sign up for a consultation to meet me or my firm about discussing managing your portfolio in a fiduciary standard that is in your legal best interest. You know, today's topic is really about real money manager versus fake advisor. And unfortunately, so many investors don't know the difference between suitability and fiduciary. And I want to talk about that today. Fiduciary versus suitability, why should you, the investor, care? I'll tell you why. Those two words or those two standards mean a lot in the care and the advice you're going to receive from a real investment firm. With that said, 10% of investment firms are fee-only registered investment advisory firms. 10%. 90% of most of these advisors or vice presidents of investing or financial planners, whatever titles they want to utilize, which are often deceptive and meaningless, are really salespeople working for Wall Street, banks, and insurance companies selling products they're required to sell and their companies manufacture that are often inferior and expensive. So 90% of advisors are not really advisors at all, and they work what's called under suitability. We're going to explain those two definitions today so you understand why you want a fiduciary advisor who's fee only, and you want to avoid at all cost anybody who sells commission-based products, Wall Street, local investment departments at the bank, and especially annuity salespeople. Hire a real money manager, not a slick salesman from Wall Street. Too many investors hire somebody because they have a rosy personality, but there's no credentials, nothing under the surface other than somebody who reminds you maybe of your son or grandson. At the end of the day, that's not real investment management, and that's not real advice. Now, while that person may not be trying to harm you, suitability itself is harmful to every investor because the conflicts, the cost, rob your returns and cost you valuable money that you should have in your own pocket for retirement. Fact, fiduciary standard, fee-only registered investment advisors, or RIA as we are called, adhere to what's called the fiduciary standard. We have a legal obligation always to work in your best interest, and we actually manage your money. Fact, suitability standard. This is the vast majority of so-called advisors, financial planners, vice presidents of investing, people with deceptive titles. Work as really brokers or salespeople, and they don't have to work in your legal best interest. They only have to sell you products that are suitable, not that are the best or the least expensive. And they're often inferior products that their firms manufacture and are required to sell you. Your interests are put at the back of the line if you're working with anyone under suitability. What you want is a fee-only fiduciary. I'm going to bring up this quick disclosure, and I want you to read this. Your account is a brokerage account, not an advisory account. Our interests may not always be the same as yours. Please ask us questions and make sure you understand your rights and our obligation, including the extent of our obligation to disclose conflicts of interest and to act in your best interest. We're paid both by you, and sometimes we get compensated based upon what you buy, better put, what they sell you. Therefore, our profits and our salesperson's compensation vary on products over time. Ask yourself this simple question. If you read that disclosure, and by the way, that disclosure or something very similar shows up on every brokerage new account agreement the investor sign. What it tells you is you're dealing with a salesperson, not a real advisor. You're paying hidden costs and hidden fees you may not know about. There's substantial conflicts of interest if you're dealing with any Wall Street firm, any bank, or any insurance agent. Substantial. That comes against your goals and your money. Why do people utilize advisors, or so-called advisors, I should say, under suitability? Because they don't know the difference. There's been numerous studies that ask investors, do you understand the difference between a fiduciary standard and the suitability standard? Typically, about 85% of investors never heard of the two different standards, nor do they understand them. But if they're asked, would you continue working with the firm once you understood fiduciary and suitability, most investors would say, I would never want to work with somebody under suitability, but I can almost guarantee you, probably 90+% of the investors right now listening to my program, you're working with somebody under suitability, their interests and their firms are different than yours. Let me give you an example of that. Let's say you're sick. You go to see your licensed doctor, real doctor. He does a complete exam. He does blood work, he does tests and labs, and then over the next week he scours over all that information. He looks at it and diagnoses your illness. He then prescribes the best possible treatment at the lowest cost. In a few weeks, you're cured. That doctor, that licensed doctor, because he is actually a fiduciary, by the way, worked in your legal best interest and gave you the best treatment. That's what you want. If you're working under suitability, this is how the story goes. You're not feeling well. You go to see Mr. Doc, who's really Gypsy Mystical Healer. He's using a deceptive title of Doc because you think Doc means licensed doctor, and it doesn't. He takes a look at you, and in 5 minutes, he waves his hands, and he says, I know what's wrong with you. He goes to the back of his dirty cart, he concocts a potion, and he sells you that expensive potion for a big commission. A couple weeks later, you're still sick and you're suffering. Now, of course, that doc, the Gypsy Mystical Healer, got kickbacks for the supplies that he put in his special tonic that he gave you that didn't make you well. He made a bunch of commissions. His interests were not the same as yours. He worked under suitability. Brokers, brokerage firms, Wall Street, insurance companies, people that sell annuities, the local investment rep at the bank, typically work under suitability. They don't work in your legal best interest. They work for their brokerage firm or insurance company or bank, and they represent them and not you. You always want to hire a fiduciary firm and not a fee-based firm. Still conflicts of interest and high cost. Hire only a fee-only registered investment advisory firm. Avoid these salespeople. Stockbrokers, insurance agents, annuity salespeople, advisors, financial consultants, wealth managers, or registered representatives, all who benefit by selling you financial products for commission, extra compensation, have revenue sharing agreements with different firms. Avoid these firms because it does come against you and your money. There are real investment managers out there, and again, those are fee-only fiduciary money managers, 10% of the investing public, not the 90% that are fee-based or commission-based that, again, work for broker-dealers, Wall Street banks, and insurance companies. Fiduciary Registered Investment Advisor. Go to my website right now. You can download for free. We put together a great report. It's actually entitled Your #1 Investment and Retirement Risk, Fiduciary versus Suitability. It's at the bottom of our homepage at our website. You can download it for free. It'll talk more in detail about the difference between suitability and fiduciary. There's also a questionnaire that you can utilize when you interview the next potential firm, or if you're not sure if the person that you entrust your life savings to is a fiduciary and fee only, utilize that questionnaire. Ask that firm the questions. If they won't answer the questions in front of you and sign off as a fee only fiduciary, You have a salesman and a sales organization who's working under suitability, and their interests are far, far different than yours. I'm going to go to a quick question. Joe from Davie, Florida. Do you think target date funds, or what do I think of target date funds? Great question, Joe. I'm not a fan of target date funds. All a target date fund is let's say you're going to retire, as an example, in 20 years. So you would essentially pick a target date fund that is dated 2035 as a number. And magically, that mutual fund company takes their own mutual funds, layers their mutual funds in different configurations, charges you higher fees, and basically you just keep that fund and set it and forget it, and they magically change that allocation as you get closer to retirement. Don't buy it. What you want to do is construct a portfolio out of less expensive, in your best interest, ETFs or exchange-traded funds. Remember, brokers and brokerage firms and so-called advisors like to sell their products that give them bigger commissions and their firms bigger fees. I don't like target date funds. What you're going to do is create your own allocation that's better for you. Target date funds are expensive, often have more risk than investors think they do, and all it is a static asset allocation failed pie approach that Wall Street has been pushing for decades. Don't buy it. I would avoid target date funds and look at constructing your own low-cost portfolio out of either ETFs, or better yet, if you're unable to develop your own strategy and manage your own money, but you want real money management, call Rezny Wealth Management. We're a fee-only money management firm. We can provide exactly what you desire: upside potential, reduce risk and protection in severe down markets, and more importantly, we work in your legal best interest and will eliminate Wall Street's conflict and high cost. Larry from Boca Raton, Florida. I'm 65 years old. I have approximately $1.2 million in an IRA. I attended a dinner seminar and then visited the advisor. He has recommended that I put my money into two annuities, Allianz and Aviva, with yearly income of about $60K. Both have bonuses, but something doesn't seem right. What do I think? I think you should run away. First off, that advisor is a salesperson working under suitability, trying to sell you annuities. Specifically, those annuities, I've looked at a lot of Allianz products, and I've looked at the other firm, Aviva, also. I can tell you this: annuities in general, whether it's those companies or any of these companies, need to be avoided. There's no reason to put an IRA into an annuity. That's number one. Number two, if you put it in these company or any of these other annuities, you're going to put your money, and you're going to have surrender penalties that could last 10 up to 20 years or longer in length. Surrender penalties to get all of your money out immediately. Surrender penalty percentages that can go up 10 or 20% to get all of your money out. That's crazy. Number two, that income they're talking about, did you do the math? $60,000 a year on $1.2 million? If you divide 60 into $1.2 million, it's going to take you what? Close to 20 years to get your own money back? Where's the return? There isn't any. The other problem you have is, where's your inflation? $60,000 might sound great today, but in 5 years at just a 3% inflation factor, you're going to lose 15% of your money in purchasing power. In 10 years, you're going to lose 30%. Do not buy an annuity. They're sold under suitability. They're expensive. They rob your returns. They have huge surrender penalties. And often you pay higher taxes coming out of these things than you were led to believe. Call my firm for a consultation. We'd love to help you. I have to go to a quick break. I'll be right back with more questions after this. Hello, this is Brian Rezny. If your goals are to increase your retirement income and retire without stress, go to my website and download our groundbreaking free report. This free report covers the investment and retirement pitfalls that are often overlooked even by the smartest investor. If you're concerned about outliving your money during retirement, or maybe you want to make sure you're not leaving money on the table, this free report is for you. Know the facts. Your retirement depends on it. Go to my website, reznywealth.com, and download your free report right now. Hello, we're back. I'm Brian Rezny, president of Rezny Wealth Management, and of course, host of the Rezny Wealth Report. We're taking your questions. Send them to Brian Rezny at ReznyWealth.com. We want to help make sure you stay on track and you're not taken advantage of by a Wall Street firm, somebody trying to sell you the annuity, or the local investment rep at the bank. Remember, fiduciary matters. Suitability will rob your retirement and give you bad investment advice, conflicts of interest, and often substantially higher expenses. Do what's in your legal best interest. Hire a fee-only fiduciary. By the way, I know we always get a lot of downloads at my website at ReznyWealth.com. We have that report available. It's entitled Your Number One Investment and Retirement Risk, Suitability versus Fiduciary. Go there right now. It's free. It's at the bottom of our homepage. You can download it, learn more about, do you have a real advisor who has to legally work in your best interest, or do you have a slick salesman with a title of deception under suitability, and your interests, retirement, and life savings are put at the back of the line? Protect your retirement. Go to ReznyWealth.com right now and download that free report. Lisa from Bokeelia, Florida. How can I position my portfolio for higher interest rates? How can I build my income for retirement? Are you taking new clients? Great questions, Lisa. We are taking new clients at Rezny Wealth Management. We do have offices throughout Florida. We'll put the number at the bottom of the screen. You can call our office at any time, and you can also visit my website, ReznyWealth.com. Bottom line is this. I love your question because if interest rates go up, bond values go down. And also other income-oriented investments like traded REITs, real estate investment trusts, utility stocks often will go down when rates go up. But your biggest risk is really bonds. So if you own a bond mutual fund or you own individual bonds, remember, the longer the duration, the more volatility you have, kind of like a teeter-totter. The closer in, shorter duration, 3 years or less, very little movement. But a lot of investors are basically running out trying to get the highest yield they can because they're yield starved. And so what that means is they're buying mutual funds that are invested in bonds that pay, let's say, a 0.5% or 1% higher dividend. But what they don't understand is they're going out 10 or 15 years on the duration or the maturity of those bonds in that mutual fund. When rates go up, bond values will crater. The longer the maturity, the more you'll lose. So at the end of the day, when you're at the low of interest rates like we are today, they could probably go a little lower, but chances are they're either going to stabilize or go up over a long period of time. As rates continuously move up, if the economy continues to get better, you as the investor are going to see principal decrease in your bonds and in your bond mutual funds. Stay short-term maturity. One of the things I would stress if you're trying to get your portfolio geared up for higher income, income doesn't have to just come from the dividend or the interest from that bond. It can come from what's called total return. Total return is income or dividend plus growth or potential growth of your portfolio combined. So if you had a bond that pays 3%, or I suggest you look at maybe an ETF that invests in a broad basket of large cap equity stocks, and it pays a 2% dividend, but it has a potential to grow 3 or 4% a year, your total return would be 7%. You could take 3 or 4% off each year of the growth, still leave some in for future potential for higher income as you need it with inflation. Too many investors don't understand the risk of bonds, and most investors think that stocks are the only thing that has risk. All asset categories. I don't care if you invest in gold, real estate. Remember how real estate fell 50% in 2006 and 7 as the market collapsed? Bonds can drop, gold can drop. All asset categories will have fluctuation. The key with investing is do not buy overvalued investments. If I look at the bond market in general, and investors, again, are starved for yield. They're chasing the highest dividend or yield on bonds. So it's kind of like trying to pick up a dime in front of a rolling steamroller. You're taking a lot of risk for just a little reward. Reduce your duration. Look at total return. Better yet, our firm, I believe, does a great job in total return investing for retirees. Call our firm. Let us build you a quality portfolio actively, which includes risk management, so we can help build you total return so you can still get the income you need with the potential growth you deserve in order to combat inflation. Steve in Naples, Florida. My broker wants me to buy the MFS Bond A, symbol MFBFX, for 30% of my retirement portfolio. I don't feel he's looking out for me. What are your thoughts? Steve, first off, you are dealing with a broker. That's a commission mutual fund. Brokers, advisors that work under suitability, as we talked earlier, are required, again, required to sell the products their firm sponsor or manufacture. Not the best products, not the cheapest products, the ones that they're required to sell. So your broker is required to sell you that fund. It's not the best mutual fund in the bond side, I can tell you that right now. I would not use it. I would rather have you look at an ETF exchange traded fund. And ETF stands for exchange traded fund. There's many different kinds of them. There's some in bonds, some in equities, some in gold, and so on. So if you look at an ETF, you might want to look at something, let's say, like the iShares Aggregate Bond, symbol AGG. It owns a good diverse basket of bonds. It's about a 5-year maturity right now, which is a little long in the tooth, but if you combine that with, let's say, a floating rate ETF bond, you basically could bring down that duration maybe between 2 and 2.5 years, which I think is acceptable at these levels. Most bond mutual funds, generally speaking, have higher expenses than ETFs substantially. They usually have loads, and that one has a load. And your broker just wants to say what's going to line his pocket versus what's best for your overall retirement. Also, I would not put 30% in that one bond fund. I think you need less duration, and you need a better potential to weather the storm in bonds as rates slowly move up. Glenn from Miami, Florida. I have about $80K in Roth IRAs, and I'm considering transferring to a Matthews Fund, MACS, or the Vanguard VDE. This would be an investment that I could hopefully hold for the next 15 plus years. What do you think? I'm glad that you're looking at least at an ETF, which is that Vanguard VDE. Not necessarily one that I would use, but it's not a bad one. The Matthews Fund also is not a bad fund overall. What I would say is, I'm glad you're looking at the longer term. Too many investors expect to make instant gratification. What I would say to you is this: I like emerging markets over the longer term. You might want to look at the Vanguard VWO. Fair disclosure, from time to time we may own that fund. That would be one that you might want to look at instead of the Matthew Fund. Another potential you might want to look at is small cap in the U.S., like the iShares IJR. And again, fair disclosure, from time to time we may own that ETF in addition. We like ETFs more than we like mutual funds because the cost structure of ETFs is very, very low. It can benchmark any of the main indexes or asset categories, and it gives you, the investor, good diversification, but at a really low cost. But again, I'm glad you're looking at the long term. Too many investors don't look at the long term, and all they do is they look at their accounts every day online or monthly, and they watch short-term fluctuation. They make knee-jerk decisions on the short term, which hampers and brings down their portfolio returns. Bill from Naples, Florida. I own shares of the Dirksen Daily Gold Miners Bull 3X NUGT. What do you think of that fund, and what about gold overall? Bill, you must be a risky investor. That is a leveraged 3 times the gold miners. I would not buy a leveraged fund, period. There might be a situation that I might use a leveraged inverse on the stock market for a little bit of a client portfolio to hedge, or maybe on the bond side, but I wouldn't put my money in that particular fund. Gold and the gold miners are extremely volatile. You magnify that by 3 times leverage, you're swinging all over the map. Gold is in a downtrend, and reasons that gold typically goes up is high inflation, which we don't have, geopolitical events, which we do have a number of in the last quarter or two, but what has gold essentially done? It's gone down. The fund you're putting your money into is huge risk. I can tell you, you haven't probably done your research on that. I would not touch that fund, and I would really look to have your money professionally managed, because you're probably not running an investment strategy, and you're looking for the biggest bang for the buck, which is going to come back and hurt your portfolio and probably cause you substantial losses in your retirement. Peter from Fort Myers, Florida. Are you advising short and mid-term bondholders to sell now? This is what I would tell you, Peter. Generally speaking, remember, when interest rates go up, bond values go down. The longer the duration, the more volatility and the downward you can have. Interest rates on the 10-year right now, let's say, are around 2%, 2 plus. Rates could go to zero, yes. Probably not realistic unless the economy gets so bad, which we're not seeing. We're seeing expansion in the U.S. economy. But with that, if you're an investor in more midterm bond or bond funds, let's say bonds that have maturity more than 5 years, I would be a seller. I would be positioning more in short-term maturities, 5 years or less. Try to have an average duration about 2 to 3 years max. And the reason for that is simple. Rates are pretty darn low. You've had a couple decades of rates slowly going down, and it made bond investors look pretty good, or bond funds. So what investors do is they buy on past performance, not understanding that bonds in the next decade cannot make the kind of return they made the last decade because rates are kind of at rock bottom prices. So do you want to put your portfolio at risk by owning too many bonds or bond funds on long-term maturity? No. So definitely sell anything 5 years or higher maturity or individual bonds. Position that portfolio in a little bit more cash if you're trying to be more conservative. Use floating rate type securities or floating rate bonds and short-term duration. You might want to look at something like I talked earlier, the iShares IGG, which I think would be something you might want to take a look at. Fair disclosure again. We often will own that in a client portfolio, but take a look, do a little research. Floating rate or basically fixed rate bonds, but short-term maturity, definitely under 3 years, and something around 2 to 3 would be more suitable in the low interest rate environment we have today. Folks, I'm getting close to out of time, and I want to kind of talk a little bit again about the economy. We're seeing improvements in the U.S. economy. We can look at our crystal ball, which is really hardcore research, and we see improvements. We like what we see. We're not short-term investors, and remember, all investments will have short-term bouts of volatility. Don't be an emotional investor. Don't throw in the towel, and don't do bad things with your money. Go to my website, ReznyWealth.com. Download that free report, that fiduciary versus suitability. Find out, is your advisor really an advisor, or are they a salesperson working against you, your money, and your goals with tons of conflicts from Wall Street, banks, and insurance companies? Anybody that sells commission problems or commission products should be avoided because it will become a problem for your portfolio. Go to my website, ReznyWealth.com. Also call my firm for a consultation. If you're tired of bad investment advice, there is a difference. We'll see you next week. Have a profitable week.